The art of survival in the reverse mortgage marketplace. Welcome to this week's edition of the Industry Leader Update. It's no secret. Recent, although much needed changes to the federally insured reverse mortgage program have created a challenging environment for originators and lenders alike. Beyond keeping up with product and regulatory changes is the remaining difficult task of doing business in this brave new world of reverse mortgage lending. Originators are feeling the impact with fewer borrowers qualifying due to reduced principal limits or lending ratios, while lenders are seeking to adjust to lower revenue in the wake of HUD's elimination of the standard fixed rate product. Now, much of the pain today can be attributed to the protracted process of our redirecting our focus to a new demographic. Case in point, our need to move from the typical needs-based borrower. These individuals are most vulnerable to not qualifying due to their lower home values and higher mortgage balances, which may place them outside of the new lending ratios or principal limits. Any marketing efforts that are primarily focused on this group will result in higher lead acquisition costs and increased spike in cost per funded loan. The challenge is not so much for our existing market, but our lack of market penetration outside of our typical borrower. Today, our industry has closed loans for a mere 2% of eligible households with borrowers 62 and older. While demographics show a massive market opportunity, growth will remain stunted if we only continue to penetrate our typical 2% market share. And this is despite the present wave of retiring baby boomers. The need to expand our reach becomes even more crucial once the financial assessment is enacted this year, and that will further filter the pool of typical eligible borrowers. Now, despite these changes, the future does remain bright and full of opportunity. More financial professionals are embracing the HECM program as a mainstream component in retirement planning. Now, this is due to the dire state of retirement savings, and it demands a solution that does incorporate home equity. So, what can we do today to ease our transition? How can we collectively weather the storm? Well, first, let's look at new market opportunities. Are you engaging with local financial professionals? Or are you working with builders and real estate professionals? Have you reached out to your local banks and credit unions with senior clients that have home equity lines of credit, and they may no longer be able to afford fully amortized payments after making interest-only payments for the last 10 years? Now, these are just a few present opportunities. The originator's ability to survive hinges on these intentional efforts. Now, next is diversification. We must examine our business model and avoid pulling from only one lead source when possible. Any business plan that is built on only one lead source is vulnerable. However, plans that are built on a variety of lead generation sources are more robust, being able to absorb a downturn in one medium while others may produce more results. Now, what are your thoughts? What are the key changes that you see originators and lenders need to make this year to push through our temporary challenge? Leave your thoughts in the comment section below and have a great week.